Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Start of a fresh new week. Lots of triggers, lots to talk about. We're coming to you, of course, after 5 weeks of straight, non-stop kind of gains. I mean, the Nifty is up from the lows of 21,743, up somewhat 15-16% or so. It's been one way. Where do we go from here? That's the question. I'm Prashant with me, my colleagues Nigel and Survi. Guys, hi, morning.
Morning.
Hi, morning. Well, yes, cues are a little more somber as we look at, whether it's the US Moody's downgrade, whether we look at Asian markets this morning. But guys, it's all, grey and black, lovely skies in Mumbai.
Monsoons, yeah.
The pre-monsoon activity has picked up, though I know that there are reports that I think in some parts of Maharashtra, it's, a little bit of an issue with the crops because it's ahead of time. But nonetheless, I mean, monsoon bounty, looking forward to it.
Well, indeed, the heat, though, post it rains, it gets a little too much. But that said, it's going to be an interesting trading session. As Prashant said, we've had a good run. Let's get straight to the action.
Yeah, now it will be not pause, but will be kind of... there is enough to pause for consolidate. I think that's broadly, the way I'm looking at things. And I'll tell you why. There are basically two themes I want to touch upon this morning. There's not too much day on day, and there's not too much to pick up on Friday in terms of what happened or what's happening this morning in Asia to really sort of, in that sense, read the tea leaves. So the markets continued their rally, and there have been two 90-day pauses, right? I mean, so much has happened in the last 1 month. It's kind of incredible. But you've had 90-day pause on the 9th of April for reciprocal tariffs. The rally started then. And that continues. You had another 90-day pause, this time between US and China, which came last weekend. And that, right out of it, I said, well, this is tactically risk on for markets. And, markets have just continued on. And they've done very well. So last week, if there was, if you need evidence, Nifty was up 4%, Nifty Bank was up 3%, mid-cap index was up 7%, and the small-cap index was up 9%. That is just last week, 1 week. And this kind of is after that weekend. We came out like a Monday, this Monday. This was, of course, the last Monday. And unexpectedly, US-China tariffs would drop down to 30 and 10% respectively, much better than anyone thought. Now, most markets, after the rally we've had, I mean, for example, the S&P 500, the biggest, the most diversified index in the world, the most tracked index in the world, has rallied 24% from the April lows. It's 3% away from its February highs. So most markets around the world are pricing in little to no damage from Trump's tariff policies. Could this really be true? That's the point. Now, I think that this assumption that there'll be little to no damage is perhaps wrong. But it's just too early to fight the trend. I mean, if you're trading, if you're in the markets, you may have a view, but what you do has to be sort of timed correctly as well. And maybe it's not just still the time to fight this trend, this broad uptrend that we have been seeing. But it's time at least to wait and watch and maybe lighten up a little bit if you're aggressively sort of been trading and riding this up move. The question to ask is this: has the good news on tariffs peaked? Now, the good news was, the last big tariff good news was US-China. So is that kind of the top as far as this entire tariff news flow, good tariff news flow is concerned? We'll have to see. No one thought that the US-China thing will happen the way it did at the rates it did. So it's a question we'll just have to wait for answers. Now, but remember this, even after what has been done, and this is nothing new, US effective tariff rate for China began this year in 2025 at 11%. And even after the drop, what we have now is 39% effective US tariffs on Chinese imports. It's still massive. It's still very, very large. And is it really the case that there won't be any impact whatsoever? Now, just two other things, right? One is the US bond market. Will that start to come into focus again? Are US Treasuries vulnerable once again? And I'll give you two reasons why. One is Moody's downgraded the US sovereign rating from AAA to AA in line with other rating agencies. It's not earth-shatteringly, a big market-moving kind of an event, but it does point to the fact that this is still a thing, right? The House Budget Committee rejected the reconciliation spending bill on Friday. There was supposed to be another bill Sunday night, and the point is this will get passed at some point. Maybe not now. By the time you sort of in the autumn session, as some are saying on the outside. But the point is this will get done. But again, the thing is, there's a organization called the Committee for Responsible Federal Budget. They estimate that the current bill, this bill, which they're trying to pass, this would add 3.3 trillion to the debt, US debt, by F5 2034. So if you remember Scott Bessent and his threes, right? I mean, 3% inflation, 3% growth, 3% bond yields, and I think I don't remember what are the other 3%. But I mean, what is being proposed now, this is completely away from any of those 3% kind of levels. You're actually talking about $3 trillion in additional deficit by 2024. So I think the question once again is, will bond markets start to wake up and kind of reassess what they need to do, how they need to price some of these spending plans? It's very different from what they began by saying in terms of they want to cut spending, reduce the size of the US government, etc., etc. Just quickly wrapping out things with just two levels. On the Nifty, support stands at 24,738, the 40-hourly exponential moving average. And the Nifty Bank support stands at 54,442. And one is the 40-hourly, the other is the low that we saw on Friday last week. Upside levels are well understood, well known. I'm not getting into it. GIFT Nifty will give you a quick sense of how we are likely to start. It's about 11 points lower. So it's a measured and slightly flattish kind of start this morning. Surabhi.
Yeah, absolutely. And, for what it's worth, this whole talk of Moody's downgrading, and now they're in line with the other rating agencies, that is kind of putting a lid on the enthusiasm this morning across Asia as well, because a lot of the Asian markets are tracking red, whether it's the Nikkei or whether it's the Chinese markets. The Chinese markets, by the way, in addition, are looking at data, and data points are mixed. So the retail sales number that came in for April, that has missed estimates. It's also lower than the March number. Retail sales in China are at 5.1% growth for April. The industrial production number has also slowed down. The April number is lower than the March number, but it's not as bad as the market had expected. So the industrial output number is 6.1% in China. So the numbers are keeping markets fairly range bound. And then, of course, there is the US bit as well. In the US, by the way, this widely tracked sentiment indicator, the University of Michigan Consumer Sentiment Index Survey, that indicator fell to 50.8, the print that came out, versus 52.2 in April. And that's the second lowest reading on record for that indicator. But anyway, on Friday, the market was in a good mood till this Moody's downgrade news came in. In fact, for the week as a whole, if you talk about it, I mean, the US market, S&P 500 is 5.3% higher, Dow 3.4%, NASDAQ 7.2%. Those are the kind of gains we're talking about just last week in the US market. On the trade front, never a dull moment. Let's pull up the latest tweet or post from Mr. Donald Trump. Now he's saying that Walmart should eat the tariffs. That was the weekend headline. He's saying both China and Walmart, between them, should eat the additional tariffs and not charge valued customers anything, he says. He says, I'll be watching, and so will your customers. And this is in response to the Walmart management indicating that prices are bound to go up as these tariffs kick in. So this is, a never-ending saga that continues. On trade, by the way, this week is very, very critical for us here in India. What is the future shape and, form of the India-US bilateral trade agreement? Will it get done? What happens? Because there's been a lot of back and forth. The Commerce Minister is, of course, in the US, and he will be meeting both Commerce Secretary Lutnick as well as USTR Jameson Greer this week. And then the official level talks will continue through the rest of the week, right up till Thursday, Friday. And we know what's happened because, on social media and on public forums, when he was in the Middle East, Donald Trump, the US president, was indicating that India has offered zero tariffs, all is okay. Then the external affairs minister came in, our external affairs minister, that is, saying that nothing is done till it's done. It needs to be a mutually beneficial deal. So this is very, very crucial in terms of the progress on this deal as we go forward. On the markets, the Nifty got into a bit of a consolidation patch by the end of the week, by Friday. But the mid-cap market has been, up and about, lots of flair out there. So let's see. The flows picture is still very, very strong. So if you need that push to come in, the bulls have that ammunition with them. And look at the kind of buying. FII buying of 8,800 crores on Friday, and domestic buying worth 5,200 odd crores. So pretty solid numbers, no problems when it comes to foreign or domestic participation. Lots of stocks in focus and some very interesting developments in the telecom space that I'll watch out for. Bharti Airtel seems to be indicating, why leave us behind? If you're talking about any kind of an AGR relief from the government, why shouldn't we get it? That's exactly the point that they've raised, saying that the relief should be granted in a non-discriminatory manner to all license holders. They're also saying we'll also have operational difficulties if the interest in the penalty is not waived off. And today, the Supreme Court could be taking up Vodafone Idea's plea, another plea of reviewing the AGR due. So let's watch for this space. Divi's Laboratories, pretty good numbers. And Zen Tech. Defense has been the theme and the flavor. We'll have the management, by the way, join us today as well. And it's been a blowout number for Zen Tech. The profits have moved from 30 crores to 100 crores. Revenue has doubled, so on and so forth. Margins are soaring. So lots more coming up with that management. Plenty to keep us occupied and busy. Nigel.
Well, that's right. In terms of flows and the liquidity in the system, it's actually very, very healthy. Because I was looking at the equity mutual funds and the holding that they have equates to around 2.15 lakh crore. I'll tell you what, that is 7% of the equity AUM. So good amount of ammunition is what the domestic mutual funds are sitting on, which will hold us in good stead in case there is a lot of supply of paper and also in case the world gets a little bit jittery as well. So this actually is a positive from an India market perspective. What did the FIs do in Friday's trading session? They unwound some longs. 5,000 contracts were down out there on the long side. They, we had some addition in terms of, short positioning as well. And now, in fact, they continue to remain net short with close to around 58% positions on the short side. Even if you look at it in absolute terms, the FIs are net short while the clients, well, they are net long. And actually that combination is not such a bad sign. When you have the FIs that are net short, 23,000 contracts on the short side, the clients at around 11,000 contracts on the long side, that's been actually a winning combination. So let's see how that goes this time around as well. The options data comes up for you, and the PCR last week had moved to around 1.3. And at that point of time, we said maybe there could be some kind of cooling off, and there was some kind of cooling off. So the PCR is now in the middle of the range, 0.6 on the downside. On the upside, it's around 1.5. So it's holding around that 1 odd mark. And two strikes are very active. The 25,100 call, close to 28 lakh shares getting added there. The 25,000 put as well, that as well as added close to around 24.5 lakh shares out there. And you punch in the premiums and you get the broad levels. So on the upside, the Nifty is expected to see some kind of resistance at around the 25,250 odd mark. That's the important mark. On the downside, this range actually is very, very important because the Nifty took some time to get past the 24,800 odd mark. Now on the downside, that becomes the first level of support. And if you break that, then you're looking at the 20 DMA, which is a few hundred points lower from there. The Nifty Bank, that's been taking support at around the 20 DMA. We saw last week as well, it went to that level and then it bounced up. But now the 20 DMA has moved up a little bit. So it's at around that 54,950 odd mark. So this is the crucial range, 54,400 to around 54,900. You don't want the Nifty Bank to break this range. And as I've been saying the last many times, this 56,000 mark on the Nifty Bank remains elusive. We need to decisively conquer this to start the next leg of the up move. Remember, in the last 1 month or so, we have gone there numerous times, but we couldn't conquer that mark. So the GIFT Nifty is suggesting some kind of volatility, but I think the liquidity in the system is something that will hold us in good stead.
Absolutely, a lot of liquidity, especially with domestic mutual funds, and Nigel has been highlighting that on the program here. Well, Ed Yardini is president at Yardini Research. He's with us. Ed, good morning. Good to have you with us here. Thank you for your time. Just a quick word on the U.S. Treasuries and this bill and then the Moody's action, Ed. Will we start to talk about U.S. Treasuries once again in a vulnerable kind of a way? What's your sense?
My sense is that there's no surprise here. Moody's was the third rating agency to lower the credit rating of the United States. S&P did it first back in 2011. Moody's was just telling us what we all know, is that the government, U.S. federal government deficit is too large and there's too much debt. But I keep pointing out that the bond market seems to have no problems. I mean, the bond yield is at basically 4.5%. That's where I thought it should be. That's kind of the new normal. Which is kind of the old normal that we had before the great financial crisis. So all in all, I'd say it's a non-event.
What about this bill, Ed? It's more also the signal, right? that this is, I mean, is there anything new? Is there a shift? Everyone seems to be okay with it. You know, you're front-loading tax cuts. Any of the spending cuts are loaded for later. I mean, it's typical what any administration would do. So,
Yeah.
I mean, in that sense, that realization, is there a shift to be had in markets because of that?
But there could be. I mean, I think the bond market is watching Washington very, very carefully, and the assessment of how this bill will have, what impact this bill will have over the next 10 years on the deficit, on the amount of debt relative to GDP, is very important. But keep in mind that the U.S. has the largest sovereign debt capital market in the world. There's obviously demand for Treasuries. If the bill turns out to be disappointing, then we will see the bond market indicating that with a increase in the bond yield. I don't think we're ever going to get a situation where just nobody's going to show up at a bond auction. I think it's just a matter of the extent to which yields are pushed higher to levels that create a possibility of a recession. We don't have that right now. I've often said that I'll worry about the deficit and the debt when the bond market worries about it. So I was somewhat worried in 2023. I was not worried back on August 8th when the bond yield went from 4% to 4.5%. I think that was sort of a technical aberration with regards to a basis trade. But if I see the bond yield going back to 5%, that would be an indication that the bond investors are not happy with this bill. But at the same time, they might be very happy with 5%, just the way they were in 2023, and they may just jump to buy these things at that level.
Ed, hi, morning. Great to have you on.
Thank you.
What sense do you see around you, hear around you on now both India and China in terms of, taking some money out of the US and putting it in other markets? Because on China, of course, there's the deal. But on India, the geopolitical overtures, the tone, the tenor, the talk, it's not been all bonhomie, so to speak, because of what's happened with Pakistan. And now we have the trade deal, US president saying India's offering zero tariffs, Indian officials saying it's not done till it's done. So, I mean, the commentary between the US and India has not been the best, should I say, in the last 2 weeks. Your thoughts?
That's correct, but everything's relative, right? I mean, on a relative basis, the conversations that the United States has had with other countries has been even worse than anything we've seen with India. So on a relative basis, things look pretty calm versus between the U.S. and India. And India, I think, still stands out as the country that's probably going to have less of a trade war issue in the United States than other countries might have, particularly China. I don't know that this China trade war is going to go away. It's the Chinese aren't going to be all that flexible in the demands that the United States is imposing on them. The United States isn't making anything like these kind of demands on India, and I think as we saw, the Chinese retail sales were somewhat disappointing. The industrial production is strong, but that's also disappointing because that much means that they're just continuing to deal with their weak economy by pushing their manufacturing sector. And a lot of that goes into exports, which creates deflationary gluts around the world. So I think to the extent that global investors are looking at where to invest, India obviously looks better than China. Didn't do so a few months ago, but I think now it does again.
All right, Ed, very quickly before we let you go, S&P 500, I recall the last time we chatted, you said, you're lowering the target, I think, from around 6,500 to around 6,000. Well, post that big bump up that we saw last week, we're almost there. Do you want to revise the S&P 500 target? And also, what about gold? After a while, gold cooled off.
Right.
Where is that asset heading?
Well, I wasn't the only one on a week ago Monday that decided that with the Chinese deal, at least reducing at least de-escalating the war with the trade war, I raised my target for the S&P 500 from 6,000 back up to 6,500. I mean, it's conceivable I'll be regretting that I ever lowered it from 7,000, which is what my target was at the beginning of the year. But the earnings picture is starting to look a little bit tired in the United States. And so what we've seen here is sort of a valuation-led melt-up that is kind of bringing us back to where we were at the beginning of this year, with more concerns about the trade war, more concerns about at least the temporary inflation surge. So that's where we are right now. But next time you interview me, you'll probably tell me that we're awfully close to 6,500. So what do we do next?
All right, Ed, thank you very much. Absolutely, we'll look forward to that. Thank you for joining us here on CNBC-TV18. Well, let's just quickly run you through the interactions which are lined up here over the next 2 hours or so. So you'll hear from the management of Zen Technologies. Stock's done phenomenally well coming into this week. 9 o'clock, you'll have Galaxy Surfactants on their fourth quarter numbers. Sanjeev Prasad of Kotak will be with us at 9:20. 9:30, Keynes will be with us on their fourth quarter earnings. Data patterns at 9:40 on their performance. And of course, we'll have Vinati Saraf of Vinati Organics to talk about their earnings and outlook, more importantly. Towards the end of the show, it's the economy. Lata in conversation with SBI Mutual Fund and Bank of Baroda to discuss how big will RBI's dividend be and what will the likely impact be. Stay tuned.
Well, we'll slip into that short break. You come back, we'll get straight to our top 10 segment. For the time being, I give you a sneak peek into the list. We're looking at Divi's, HAL, Delivery, Premier Energies, Hyundai Motor India. All of them will be reacting to positive news flow. Add to the list Zen Tech and BEL. On the flip side, Credit Access Grameen and Protein eGov will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. Like we've been saying, the cues are a little cautious across the Asian sphere as well. This is back because of the Moody's downgrade, and in general, some profit-taking seems to be the order of the day. There you see the Hang Seng's down about 0.5%. Most of the markets, even Japan, slightly lower. The implied open will come up. The question is whether bulls can continue their charge, given the strong performance last week. 9 points down, at least for the time being. Lots and lots of stocks in focus. So let's straight away get to our list of stocks to watch today with our team standing by. Guys, morning to all of you. Ekta, let me start off with you. Divi's numbers, how do they look?
Well, Divi's numbers, looked in line except for the operational performance, which was a beat. So the revenue came in with a growth of around 12% in line with estimates. Margins 34%, Street was anticipating 32%, and a profit of around over 660 crores, which was definitely a positive as well. Now, a couple of key takeaways from the company. They are looking at double-digit growth in FY26. They didn't specify what number they're working with. They're seeing a little more in terms of requests for proposals as well as requests due to the Biosecure Act as well as China Plus One, which is a positive. They are not working on generics in the GLP-1 space, so semaglutide might not be an opportunity for them. They're working with innovators, so that's something interesting to watch out for. Cash on books remains high at over 3,600 odd crores, always a positive. But the valuations might cap the enthusiasm today. It's trading at around 65 times FY26 and over 50 times FY27. So that might water down the expectations. But otherwise, operationally did well.
Okay, all right. Ekta, thanks a lot for that. Well, let's hop across to Ria. She's here to tell us about HAL. Ria?
Well, yes, good morning. HAL is expected to be in focus once again today after very strong commentary from the management in their earnings call on Friday. They have said that their order book now stands at rupees 1.89 lakh crores versus just about 94,000 crores that we saw in last year. Order inflows have also been very strong at 1.25 lakh crores, and going forward, they have an order pipeline of 1 lakh crores, which is expected to materialize within the next 1 to 2 years. In terms of the outlook, they've said that the revenue growth is expected to be at 8 to 10% for FY26, but they are going to revisit this guidance after 6 months, and the double-digit revenue growth that they are expecting FY27 onwards may happen in FY26 itself. Margins are expected to be maintained at 31% over the next 3 to 4 years. And another important update on the LCA Mark 1A aircrafts, 12 of these aircrafts out of the total 83 are expected to be delivered in FY26 itself after the engine deliveries from GE have started flowing in. So overall, very strong updates for HAL, and the stock is expected to open in the green today.
All right, Ria, thank you very much for that. Delivery is the next one we're going to focus on. Mangalam has got details on this one. Mangalam, morning.
Morning. So it's a good operational performance that is coming from delivery this time around, and the bottom line continues to improve. Remember, 3 quarters ago, they had changed their depreciation method, and that continues to reflect on their bottom line now as well. It's the part truckload business where operating leverage was likely to play out, and that exactly has happened. So overall revenues grew about 5.5%, but the EBITDA jumped from 45 crores all the way up to 119 crores. So that's a near 160% jump, and that's reflecting in the margins and the bottom line as well. So the part truckload business has seen a revenue growth of 24%, volume growth of 19%, and margins jumping all the way from 3.2% to 10.8%. That's been the growth driver this time around. Express parcel, however, has been slightly short of expectations, grew by just 3% on the revenue, 1% on volumes, and that's reflecting the weakness that we're seeing in e-commerce as a channel, even as quick commerce continues to do well. They have a cash balance of 5,500 crores, and the next big trigger for them would be the growth of e-com express that they acquired. So to that extent, see some green on delivery today.
Okay, all right, got it. Thanks for that, Mangalam. Let's talk about Premier Energies. Vivek is joining in. It's been a string of actually good earnings over the weekend, Vivek. Premier Energies joining that club?
Well, absolutely right. So, especially when talking about the solar cell, solar module makers, both Waaree as well as Premier, they've actually had a very, very good FY25. Premier has been no different. Just have a look at the Q4 numbers, and along with that, given the fact that the company has also given very strong capex as well as capacity addition guidance. Revenues higher by 44% on a year-on-year basis. We are talking about Q4 consolidated numbers. Operationally, on the back of significant reduction in debt, the EBITDA, core EBITDA, has jumped up 2.9 times on a year-on-year basis. EBITDA margin has almost doubled, coming in at a little over 32.5%. Profitability higher by 2.7 times. The order book quite strong at 5,303 megawatt, giving it a revenue visibility of close to 8,445 crore. Now the order books split modules, solar modules at 73%, cells at 27%. Now the company has also gone ahead and envisaged a significant capex plan of close to 1,250 crore. Now this is an FY28 capacity addition target, which is what the capex will be used for. Cells, the company expects capacity at 10 gigawatt, modules 11 gigawatt, ingots and wafers 10 gigawatt, aluminium frames 36,000 metric tons, and battery storage cell pack at close to 12 gigawatt hour. The management will be joining us later in the day today at midday. It will be important to ask how are the spreads actually panning out, given the fact that there's expected to be significant competitive intensity ramping up in FY26.
Okay, all right. Vivek, thank you very much for that. Hyundai is the other one we want to address. Sudarshan has got details on this one. So, good morning.
Morning, Pradhan. So, after reporting slightly better than expected Q4 earnings in conference call, company believes that export growth especially will be better in FY26, and here growth range is seen in the range of 7 to 8%. And for domestic, it believes that it will grow. Growth would be in line with the industry. On the launches by FY30, it's expected to launch 26 products, and out of that, 6 will be from EV. Also, on the margin front, it believes that it will continue to report margin in double digit. Most of the brokerages remain positive on Hyundai. CLSA maintains outperform call and target is rupees 2,155 per share. It believes that company will gain market share in FY27. JP Morgan too maintains overweight call and target is 2,060 per share. And Nomura has a buy call and target is 2,291 per share.
Okay, all right. Thanks a lot for that, sir. Well, let's go back to Ria. She's here to tell us about data patterns as well as Zen Technologies. Ria?
Yes, good morning. We have 2 more defense stocks expected to be in focus today on the back of their Q4 numbers. The first one is Data Patterns, for which the revenue has gone up by around 117% on a year-on-year basis. EBITDA and net profit have both seen increases of over 62% on a year-on-year basis. Margins, however, have come down to 38% versus 51% that we saw in Q4 of last year. For FY25, for the full year, they've surpassed their revenue guidance of 20 to 25%, and the margin guidance of 30 to 35% has also been exceeded. On the the order front, that has been a little weak. The order book is now at rupees 730 crores versus the 1,883 crore order book that we saw in FY24. The order inflow has also missed the full year FY25 guidance of 700 to 800 crores, coming in at just about rupees 355 crores in this quarter. Going forward, the company expects a revenue growth rate of around 20 to 25% and EBITDA margins to be in the range of 35 to 40% in FY26. Moving on to Zen Technologies, good results on this front. The revenue has gone up by around 130% over the previous year. EBITDA and net profit have also seen increases of 174% and 189%, and margins have also expanded to 42.5% versus 35.6% that we saw in Q4 of last year. For FY25, they've surpassed their guidance on all fronts for the revenue, EBITDA margin and net profit as well. And going forward, they do expect to execute the order from the Ministry of Defence for integrated air defence combat simulators for the L-70 gun and FY26 itself. So overall, positive updates for Zen Technologies, and expecting the stock to open in the green today.
All right. Thank you very much for that. Ria, of course, we will be connecting with the managements of both Zen Technologies and Data Patterns in just a bit from now. So stay tuned for that. Very, very interesting conversations coming up with both of those companies. All right, let's now look at Credit Access Grameen. Abhishek is joining in with the numbers for this one. Abhishek, how do they look?
Well, Credit has missed most of the guidance that they had given, which was revised twice in the last fiscal. And despite that, it's a massive miss. Take a look at loan growth. They earlier guided for 23 to 24%, brought it down to 7 to 8% in Jan of 25. However, the actual is minus 3% on a year-on-year basis. Credit cost guidance, which stood at 6.7 to 6.9%, ended at 7.7%. The return on asset, the guidance was about 2.3 to 2.4%, but it ended up at 1.9%. Even the return on equity, which they targeted about 10%, is less than 8% for them. So asset quality is the key reason our gross NPA has increased by almost 25.7% on a sequential basis. So gross NPA ratio is now at 4.76% versus 3.99% in the previous quarter. The net NPA ratio has increased as well to 1.73% versus 1.3% in the previous quarter. They have given FY26 guidance wherein they have mentioned that the loan growth will be around 14 to 18%. Net interest margin will be around 12.6 to 12.8%. However, the credit cost will remain elevated at 5.5 to 6%, which will impact the return ratios. So return ratios like ROA expected at 2.9 to 3.4% and ROE, that is return on equity, to be around 11.8 to 13.3% in FY26. So expect the stock to be under pressure on account of increase in credit cost guidance and the deterioration in asset quality seen in Q4 FY25. Back to you.
No, absolutely. And you know, those tables, those rows give you a clear sense of the many changes and, of course, the actual number across a range of parameters, and certainly don't look all that great. Abhishek, thanks very much for that. Protein, eGovern and BEL are the other two we want to focus on. Vinny's here with details. Vinny, morning.
Good morning. So starting with Protein eGov, firstly, this stock is going to be under pressure today, what we're expecting. The company has now been shortlisted for the PAN 2.0 by the Income Tax Department. Obviously, they had filed for this request for proposal somewhere around in August. Now, they've got that, they've come to know that they will not be a part of this plan. Now, according to sources, what was said before as well, that government had planned to spend as much as somewhere around 1,440 crores as a budget for PAN 2.0. Equirus says that this is a negative impact that comes in for the company because 50% of their services are actually PAN-related services, the revenue contribution. Now, apart from that also, this was a free cash flow kind of a generation that came in from PAN services that led to new initiatives by the company. So this is surely going to impact the initiatives going forward as well. And that is why a red is what one could watch out for. Equirus have downgraded the stock to a sell and from a previous ad rating, cut the target price to 900 as well. Even Anand Rathi has said that this will see a sentimentally negative opening today as well in terms of the near-term outlook, but limited impact because offline business is still intact for the company. Now, BL on the other hand, we're expecting green coming in for the stock. They've secured additional orders of around 572 crores. And this is since April 7, 2025 that they've secured this order. This is mainly for drone detection, software-defined radio, as well as some data communication for attack guns, some jammers, stimulators, and AI-based solution also is something that they're working on. So important to watch out for this one.
Okay, all right, got it. Thank you very much for that, Vinny. Let's quickly recap our list of stocks to watch. The ones that have positive news flow are Divi's Laboratories, Hindustan Aeronautics, Delivery, Premier Energies, Hyundai Motors, Data Patterns, Zen Tech, and Bharat Electronics. Stocks with negative news flow are Credit Access Grameen and Protean e-Governance Tech. All right, let's continue and now talk about commodities as well. Manisha is joining in with a roundup of all the commodity market action. Manisha, hi, good morning.
Morning, and thank you for that, Survi. Well, it started as a stronger note for commodities for the Asian markets right now. Well, gold, after a steepest fall in 6 months, a 3% decline in the previous week and hitting a 5-week lows, has seen some rebound come in right now. That is because the U.S. consumer sentiment has declined for a 5th monthly decline, and it's trading at around record lows right now. Also, Moody cutting credit rating for U.S. Also has supported the gold and silver buying, so 0.5% to 1% of gains coming in for the precious metals right now on the back of safe haven buying. The investors also closely are watching developments in the Iran-U.S. nuclear talks. 4 rounds of conversations already have been done. An Iran president said that the country will continue talks with the U.S. over its rapidly advancing nuclear program, but will not withdraw on its right. So this conversation is far from over. After precious metals, if you look at the energy markets, we are trading positive on that as well. We've seen 2 weeks of gains, 2% of gains in the previous week, and we seem to be continuing extending those kind of gains right now in the Asian markets. And same goes for many of these metals as well. Can't say that for aluminum, which is down 1.5% right now. But copper, steel, zinc are trading in the positive. Markets are anticipating better, improved demand coming in from China going forward, and that's keeping the prices higher.
All right. Manisha, thank you very much for that. So that's commodities in focus. We take a quick commercial break here. We're going to come back with the management of Zen Technologies on their 4th quarter earnings. Stay tuned. Coming up in just a bit from now.
Welcome back. Well, like we promised, in a short while from now, we will be discussing the quarterly updates and, of course, the P&L with Zen Tech. Before that, let's get you an update with Parikshit as well. Amidst all the ongoing issues at the border and, of course, Operation Sindoor, the Defence Acquisition Council has granted the Indian Armed Forces the right to procure necessary artillery under emergency procurement powers. Parikshit is joining in with more. Parikshit, morning. So tell us, I think replenishment is what everyone is talking about. So what does this really imply in terms of the procurement by the Army or the Air Force?
Well, yes, the focus would be on procuring loitering munitions, anti-tank guided missiles, artillery shells, counter-UAV drones, which have been used in Operation Sindoor recently. And the government is now looking to fill this gap up in the next 6 to 8 months. Now, as per the rules, emergency procurement can happen till the extent of 15% of the defense modernization budget. Now, for FY26, the defense modernization budget out of the total outlay for defense was 1,60,000 crore rupees. So we're looking at an upper limit of 24,000 crores immediately in the near term. But government sources tell us that the actual expenditure may be less than that. This is because the deliveries have to be made within a year period. So we're looking at finalization of contracts within the next 40 days. Deliveries within the next 1 year is what the Army, Air Force and Navy are looking at. And this is for all 3 services. Industry sources have been telling us that there have been regular meetings with the Ministry of Defense. And there is an expectation, there is a belief that the government would be placing orders worth 40,000 crore rupees in the next few weeks. Now, how is that structured? That remains to be seen. But this is what the industry is working with. This is what we learn. And currently, these are the orders which have been given to the 3 services, empowering them to go for emergency procurements.
Okay, all right, got that, Parikshit. Thanks very much. Very helpful information. And we'll keep this in mind as we have a conversation with a lot of the local defense suppliers. In fact, let's get to one such conversation immediately. As promised, we have the management of Zen Technologies joining in. Mr. Ashok Atluri, Chairman and Managing Director of the company, is with us. And it's been a really good quarter and a pretty decent year for Zen. I'm just recapping the numbers. In the 4th quarter, revenue is up 130%. The margin has zoomed up to 42.5%, and the profits, they've soared from about 35 crores in the Q4 of last year. The profit now is at 101 crores. And even for the year as a whole, 121% top line growth, and profits, also moving up substantially. Congratulations on a good year and a good quarter, Mr. Atluri. Now, let's talk about this. Exactly what Parikshit was saying, that I guess the procurement timelines are getting crunched, and there is major ordering that's going to happen. Talk to us about both your anti-drone part of the business as well as the flight simulators. Anti-drone, I don't know if some of your equipment was already used in the last 2 weeks or not. But basically, what kind of growth can we look at? Some numbers will help. We all know the opportunity and the environment around us.
So, our anti-drone systems were used in the operation, and, we are very, very happy that, all the investment, self-funded R&D paid off for us, and we have got very good feedback from the armed forces, and we as Zenith, we feel very proud that this happened. And with respect to the, the orders that we may expect, we, as the industry, whole of the industry has been discussing with the armed forces, we have also been very much engaged with them. And we do expect, some fast action to happen in this regard, but the quantum and the time is unknown at this point in time. And, we currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. I think they're simulator related, but again, they are also reasonably large. And so, yes, the order book orders seem very, very likely in the short term, yes.
On drones, let me start with that part of the business. It's a smaller part of your business right now. I think it's about 25%. That's the split. 27%, I believe, of your order book.
Yeah,
on drones, please continue.
Yeah, on the total, almost it was, the simulators were a little more than for the year last year, the execution. But these keep moving in as we keep getting the orders. They're very, very, but as of now, we're almost like, 50-50 in both the segments.
So I'm just trying to understand in terms of fresh procurement, I'm talking only about the anti-drone part of the business. Can you tell us how many, orders, what are the conversations in terms of quantum? What's the pipeline looking like?
So this is the ongoing conversation, and we are definitely not aware what will be the size of the thing, but the feeling is that it could be very large, and to exactly pinpoint and tell that this is the figure is very difficult at this point in time.
Mr. Atluri, two questions. One, would you want to give us a guidance? Morning, Prashant here. Guidance for F5. I think your long-stated guidance has been, it should be about 2,000 crores in top line by F527. That you maintain that?
So yeah, what we have said is that, on a cumulative basis, we should be going at a CAGR of 50%. And for the financial year, this financial year, next, and then up to FY 26, 27, 28, we should be growing at that pace. That would be a little more than 6,000 crores of cumulative turnover. We still stick by that. And but this year, we feel that it may be a bit muted because of the delay in orders, but I think things are improving very fast as we speak.
Mr. Atluri, you said 6,000? Because you're at...
Cumulative over the next 3 years, 6,000 crores,
So you're at 900 odd crores now.
That's right, yeah.
about actually closer to 1,000 crores. You're saying this number should move up to 6,000 crores? Cumulative.
Over 3 years.
Yeah, over 3 years. It's 900, 1,350 and 2,000 and then 3,000. Yeah, that's how we are trying to do that with a 50% cumulative growth rate.
So for this year, we are working with roughly around a 50% growth at least, right? So
that's what I'm saying. It's cumulatively it will be there, but this year is going to be a bit muted, Nigel. Yeah.
Got it. All right. But the cumulative number, that is on an average, if I take an average for the next 3 fiscals, it should be roughly around 2,000 crores. Because 1 year you could do 3,000 crores, another year you could do around 1,500 crores. Are we getting that point correct?
Yeah, it will be
the summation of the revenue. Got it.
Overall, it should be growing only, but I think that's what the whole point is, yeah.
All right. Got it. A quick question then. Last time we chatted, you said you're expecting good amount of order inflows. And your order book for the kind of growth you're looking at, well, it's a little bit subdued, at least as of now. But you said that there is good amount of inquiries. And in the pipeline as well, there could be some orders that will be executed. For the year, what kind of order inflow are you looking at? And for the first half of the year, I think you were hinting at roughly around 500 crores of order inflow. Is that on the cards?
Yeah, so we were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. we should be getting those orders. But with the new, situation, I think the order book position will be substantially higher.
Okay, all right. And Mr. Atluri, at least for the year, you're saying it'll be a little softish here. But year and now is what the market's interested in, right? So for the year, you want to give us a broad range. What kind of... we take that on board. FY26 could be a little bit subdued in terms of execution. And then 27 and 28 will be better. But you want to give us a rough range?
So Nigel, the thing is that once we get the order, things are under our control and we are able to predict. That's how the order book position was. But these orders have to be given by the government. Unless we get the order in hand, the total execution for the year will be very difficult for me to...
All right, Mr. Atluri, very quickly, this year the numbers look good, but the OCF is still negative, operating cash flows. Next year you'll fix the problem? Will we have a positive number?
Yeah, it will definitely be a positive number, but this is being, the cashes are coming because the government, there is a little delay.
Yeah, receivables have moved up.
Yeah, absolutely, yes, yeah. Yeah, they'll get corrected. That's just a matter of time.
So a positive OCF number we look forward to in FY26.
Right.
Any new acquisitions? You've done a few smaller acquisitions in your space. Anything else we should expect, Mr. Atluri?
We are on the lookout, and we expect that something may happen during the year, but not immediately. But during the year, the discussions are going on with a couple of companies. But till they happen, they don't happen, kind of thing. So we'll just hold it till we actually finish the acquisition.
Just one thing I want to clarify, what Surabhi began with, when we talk about replenishments in your business, on the anti-drone side, there's no replenishment in that sense, right? Or is there? Because those would be on the munition side, drones carrying munitions, etc. Am I correct?
Yeah, the thing is that first we have to acquire. The acquisition has to be completed, to fulfill the requirement. That itself isn't completed. Once it is completed, then for companies like Zen Technologies, we get annual maintenance contract for about 8 to 9 years after the warranty period, and then after 10 years life cycle is over, they replenish the equipment again.
Okay, all right, got that. Thank you very much for joining us. Good speaking with you, and good luck to you and your team as you continue to execute. So, things coming in from Zen. Stock's done very, very well over the last 5-6 days. Actually was one of the best performing names last week in a sector which, of course, has really done very well. Deepan Mehta is with us, Director at Elixir Equities. Deepan, good morning. Good to have you here. Sorry, coming to you a little late, but you heard the management of Zen, and again, defense is a kind of a constant theme with us. We are later speaking with data patterns. What to do with the space? What to do with stocks? Deepan, in your assessment, big run-ups.
Hey, Prashant, good morning, and thank you for having me on your show. I remember going to Zen Technologies plant in Hyderabad 20 years ago, and I had bought the stock also, but then it was not going anywhere for so many years. And then I, threw in the towel and sold the stock. I wish I had held it. It's been a fabulous multi-bagger, and it's in a super space to be in, the right place, right time, at least for the company. And I think great prospects. Very good interview. He's targeting 50% turnover growth, which is fantastic. Parat may justify the very rich P multiple it is trading at. So very positive on the stock, but would look to buy at declines because valuations are certainly on the higher side. Also, one needs to remember that if you look at the history of the company, there's a lot of volatility in the earnings because of the government procurement plans, and order book position may change quite a bit quarter by quarter. But nonetheless, I think great prospects for the company. And even with data patterns, I think across the board, we are seeing very good interest in defense. I know it's a great story for next 2-3 years, but look, valuations are on the expensive side. So I'd wait and watch and try and buy declines.
Just to make that point, Deepan, we are at CNBC-TV18, we used to put out a mid-cap mania, a segment long time ago. And I recall covering the stock at around, explaining the stock at around, I think, 100 rupees or thereabouts. And then I got so much of this feedback, even I was wondering, what's happening. But at that point of time, the story was more about the simulators. Yeah. And then it seems the bull sat on the drone and, that's what took off. So, something else played out. And that's why the stock is done. But I remember that period when there was no orders that came in for multiple years as well. So it'll be just, to alert our viewers. We had explained the stock long time ago.
Well, and look at it today, fully discovered. Actually, still not at its, 52-week high. It's still off. The high was
at 1,000 crores, we explained it. At 1,000 crores.
Yeah, I was like 100. Wow.
at 1,000 crores, the share price was 100.
Oh, at 1,000 crores market cap,
yes.
And the share price was 100. Whoa! And look at it today, 1,700 plus.
A viewer just told me, that's why I remembered it.
All right, we need to take a very quick break on that note. Come back on the other side. We'll just keep discussing more fundamental ideas and also get you the technical setup of the market today. Back with our technical experts in just a bit.
Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to our technical experts. We have Sudarshan Sukhani and Shilpa Rao to join us for a technical check on the market. Good morning, lady and gentlemen. Thanks a lot for joining in. Shilpa, you go first. Tell us what's your take with regard to the Nifty. We've had a very, very good run. We're holding at around 25,000 odd. What would your trade be?
Good morning, Nigel, and thank you for having me on the show. Talking about the indices sector, we see definitely a bullish sector that is happening. Nifty has surged above 25,000, and this sustenance here will definitely see the next levels of 25,500 coming in very soon. So any declines towards 24,800 should be a buying opportunity and go long till 25,500. Talking about Bank Nifty is definitely heading towards 56,300 zones. So again, a decline towards 55,000, 55,200 should be again a good opportunity to go long and stay for targets till 56,300.
Okay, got that, Shilpa. Sudarshan, morning to you as well. What would your approach be? Trading bias for today?
Yeah, good morning. See, after a big move, the Nifty normally consolidates. And that's exactly what happened on Friday. And the chances are that process will continue today also. So for the Nifty to buy at current levels for a short-term trader is not a good idea. You have to either wait it out, let the consolidation be over. It will be done in 1 or 2 or 3 days. Or if you get a sharp intraday dip towards 24,800, that's an approximate zone. If you get a dip to that zone, go and buy it. Your stops will be 24,500. If you don't get that dip, just step aside, focus on stocks.
Okay, let's get straight to stocks then, Sudarshan. Tell us individual stocks, what are you looking at?
Well, ACC is a buy with the stop under 1880. Bata India is a buying opportunity after many months. It's with a stop under 1220. Maybe it's putting its act together, maybe. Colgate is another buying opportunity, same FMCG pack, stop under 2630. And Hudco from the NBFCs is a buy with a stop under 229. There's a variety of sectors, but not the index.
Okay, all right, got that. And Shilpa, what about you?
I have a buy in Titagar. Titagar is having a splendid run, and the sustaining above 900 is definitely showing that it has more strength to see. So 960 to 980 levels can happen in coming days. So keep a stop at 880 and stay long in Titagar. The other one would be a buy in Hudco. Of course, Hudco already the levels have been given. So I will also stick to 220 levels as a support and look for targets of 260. And the third one would be a buy in Tube Investment. Tube Investment also is looking very positive. It has sustained above 3,000. And from here, the levels of 3,300 should come.
Okay, all right, got that. Thank you very much, both of you, for giving us some of the trades. We'll come back and get to more ideas in just a bit. Right now, I have to take a very quick break. Back on the other side, we'll have the pre-opening rates, and also we'll have the management of Galaxy Surfactants joining in to talk about the fourth quarter performance.
Okay, welcome back. There's a minute to go for the pre-open session, and there is a fair bit which we got to track and discuss. Deepan Mehta is with us with what he thinks of the markets, stocks, etc. Deepan, thanks for waiting. You know, towards the end of last week, one of the names which came under intense focus once again was IndusInd Bank for the wrong reasons once again. Any thoughts here? With that, newfound accounting problem in the bank? I mean, markets, if you look at the stock reaction post that, there was a knee-jerk reaction, but that was bought into. Markets are looking ahead. What's your sense?
Yeah, Prashant, very disappointed as a shareholder of IndusInd Bank that the bad news keeps on coming in. And really, I think from an investor's perspective, I would like to say that the trust factor is lost with the bank. I'm not sure it is going the Yes Bank way, or there are even more frauds or something like that. But the way the bank has been managed over the last few years or so certainly is very disappointing. And I do hope this is amongst the last of the negative disclosures which they have. Look, you buy into the bank because it has distressed valuations, and still the core operating model, the brand, the middle level management team, the technology platform, all of that is state of art. I mean, it's pretty decent compared to its competitors. And investors have in mind that, other banks like Axis, ICICI, also they had their own situation when there was a lot of turmoil in the management and as well as in the business of the company. But then they recovered very well under a new CEO. Something similar could play out in IndusInd Bank also. Let's see who the new CEO is and what their vision is and how they rebuild the top level team. Because the foundation of the bank is strong. It's just that it seems to have lost its way for the last few years or so.
Oh, yes. And those hits keep coming, as they say, right? That's the problem with IndusInd Bank. Take your point, Deepan, on this. I want to draw your attention to Bharti Airtel, because Bharti is doing something very interesting, right? I'm sure you've seen the weekend news flow. Now they've gone and told the government that relief should come to everybody on AGR. Why just one company? Why just Vodafone Idea? And they're saying that even our operations will be impacted because of the penalty and the interest. At least waive that off. Not sure how this plays out, but how are you watching this space? On Friday, Vodafone said that we cannot continue operations beyond FY26. The government needs to do more. Your thoughts on these telecom stocks?
Yeah, I think whatever the outcome of this is, it's going to be positive for Bharti Airtel. And on the whole, I think I was very impressed with the set of numbers. 17% increase in the ARPUs, that's the yield for the company, is very impressive and still at a low level and considerable scope for increasing. Free cash flow also will start to move up. And I think that next 2-3 years, it can still go at a compounding rate of about 15-16% or so. So very positive on Bharti. It's a company in which we and our clients have an investment. And I think if Vodafone is going to get impacted, then a lot of the subscribers can flow to Bharti and Reliance Jio. So they'll take even more advantage of the duopoly which they are in. And any relief from the Supreme Court will be more than welcome. So very positive for Bharti Airtel, amongst the few nifty stocks which have been able to sustain a high teens compounding growth for last 10 years.
By the way, check out Protean in the pre-open. The stock is down 19%. The news is that the company has not been shortlisted by the Income Tax Department for the PAN 2.0 project. And this obviously is going to be a big blow if this is how it plays out. Let's see if this is the final word on it or not, because Protean has been doing a lot of the back-end architecture for PAN and for other things like ONDC as well. And this could be a bit of a blow. Very quickly, Deepan, your thoughts? Otherwise, the stock was doing really well, an institutional ownership, etc. But this has come as a rocket out of nowhere.
Well, I think, this is client concentration at its best for you. Those risk factors exist. And Protean per se also was trading at very expensive valuations for a company where growth for last 5 years have been pretty much stagnant. So I think perhaps the move is justified. But, let's see, understand exactly what the outcome of this is from the management, I guess.
Any other sort of stocks, etc., come your way? Anything which is still a little out of whack, dislocated valuation-wise, Deepan?
No, these markets are priced to perfection over here, and we are really struggling to find good quality stock ideas. My understanding so far is that this earnings season has not been that great. It's not been across the board better for all the companies. Even within the sector, you have outperformers and underperformers. So I think life for the next 1 year or so is going to get a bit tough for fund managers and investors, where they have to find selectively good quality stocks to invest in. It won't be across the board. So I'm just kind of analyzing what numbers have come through so far and trying to make out a shopping list, but it's not ready as yet, and I'll share it once I have something interesting to discuss.
All right, Deepan, we'll leave it there. Thank you very much for joining us. It's always a pleasure having you here on CNBC-TV18. Nigel, we have the management of Galaxy.
Well, that's right. Let's focus on Galaxy Surfactants. They reported their Q4 numbers. Last year, it had various challenges. But let's find out what's the path ahead. We're joined by Mr. Natarajan, the Managing Director and CEO at Galaxy Surfactants. Hi, Mr. Natarajan. Good morning, and thanks a lot for joining in. Well, let's get two of the key numbers out of the way first. What kind of volume growth are you looking at for this year? I recall last year you were aiming for around 6 to 8%. This year, what kind of a number are you looking at? And the EBITDA per unit, that's the other one. I think around 20,000 is what you were guiding for last time around. So let's get both these two numbers out of the way first.
A very good morning. Thanks for having me on your show. As regards the volume growth, we would want to maintain the momentum that we have generated in Q4 and probably be still at the lower end of the guided range. We grew by almost 4% last year. We should be targeting doing that. And with regard to EBITDA per metric ton, there was a good momentum that picked up in Q4 compared to Q3. And we would want to be in the guided range of 20,500 to 21,500 per metric ton.
Okay, all right. Could you give us a broad sense in terms of your mix as well? Last year's specialty care revenue, well, that in fact saw volumes that were more or less flattish. And well, you had a mid-single digit, I think, in the performance surfactant. For this year, what kind of a revenue mix are we looking at, sir?
In fact, see, India has been, from the second half of this year, India has been a challenge, as all of us know. And the masthead specialties in India, majorly, and to some extent in Africa and Middle East, Turkey got impacted. India was more because of the demand momentum decelerating, whereas for Africa and Middle East, Turkey, it was more to do with the sort of supply chain challenges that we had. Moving forward, we expect the growth to pick up in specialties, masthead specialties as well. India, yes, we would want to be a little bit cautious, as most of our customers are expecting the momentum to build up only from H2 of this current financial year.
Speaking of various geographies, sir, what is your mix between India, rest of the world, and the other key markets? And also, I mean, what is the exposure you have to the US?
Yes, so India typically is about 35 to 40%, and you have Africa, Middle East, Turkey at about 30%, and the balance is rest of the world. US is about 10 to 12% of our revenues.
And what are the conversations? I'm sure the last 1 month or so, you would have been in discussions with clients, sourcing, supply chains, all of that, because of what's going on. What's the sense? If the tariffs, I mean, they were announced at 26% blended, we still don't have individual product tariff lines. But what is the increase that you're baking in that you think that your customers will be willing to pay for? Will it impact your operations or not, specific to the US?
No, we see with regard to the US, the most important stuff is not about what are the sort of reciprocal tariffs that kick in. We are still into the 90-day suspension period. But all the customers whom I met over the last about 60 days are pretty apprehensive about the implications it will have for the demand growth. They expect that there'll be no choice but for them to pass on the increase to their consumers. And that certainly is going to be having a huge implication on the demand growth. But as regards the products that we supply into the US, there are some products that we do import from China, but then that's not something significant into our US operations. Whereas what we export into US from India and is nothing that is going to be significantly impacting us. Whereas from Egypt, there are no reciprocal tariffs. So that leaves us in a good spot.
Okay, all right. Just a quick question on fatty alcohol asset prices. That doubled in the past year, right? And there were hints that maybe that will cool off from here on. In the first quarter, what kind of a range are you working with on this pricing? And do you expect it to correct as the year progresses?
Yeah, so as we are talking, I think the prices are closer to $3,000 per metric ton if India. More than that, there have been huge issues in terms of on the supply side because many of the plants are shut down. There has been some gas outage in Malaysia due to the issue at Petronas. It's just limping back to normalcy. So we have on one end, you have the prices which are elevated pretty significantly high. And on the other hand, you also have supply side challenges that have come into the last 2 months. The prices we do expect with the high harvesting season now, things should start cool down. And that hopefully should be able to give some strength to demand momentum building up in India because India is pretty challenged in terms of high inflation on the commodity front.
Okay. All right, so we'll leave it on that note. Thank you very much for joining in. Appreciate you telling us more about the business. That's Galaxy Surfactants talking about the outlook ahead. Let's also look at the pre-open rates. It's very quiet right now on the market. Nifty is not doing much. It's more about individual stocks. Protean, like I mentioned, Protean has to be on our radar, and we'll try and touch base with the management as well and see what they have to say. With this income tax department googly coming in, that PAN 2.0 will not include this company, which has been a huge part of the back-end infrastructure so far in services like, tax and PAN. Anyway, for the rest of the market, it's still the same theme. Some of the defense stocks, they're still running. The ones that have come out with good numbers, Zen Tech, data patterns, they're up 4-5%. BEL, the bigger names, are also up to 2.5%. But aside of that, it's a pretty quiet sort of an opening. That's the indication that we are getting in right now. Let's quickly get to our technical experts then. Sudarshan, 9-10 call?
Well, it's Hoodco. Consider buying Hoodco with a stop under 229.
Okay. All right. Got that. Let's quickly move on. Thanks for that, Sudarshan. Let's quickly move on and address some specific stocks as well. Mangalam is here. Mangalam Delivery. Let's recap the performance once again.
Well, the margins delivered this time. Let's put it that way. Because if you look at the numbers, good operational performance coming in. They had changed their depreciation policy a couple of quarters ago. So that continues to reflect on their bottom line as well. If you look at it over the, last year, the revenues grew just around 5.5%. 2191 crores is what they, reported. But if you look at the EBITDA, that's jumped from 45 crores all the way up to 119 crores. And this has been led by their part truckload business. And that's exactly where the big change has been. If you look at the part truckload business, which is not their biggest vertical, but definitely the one that caused the most amount of growth. 24% jump in revenues, led by 19% jump in volumes. This has now, stabilized after the increase that we've seen in their business through the spot-on acquisition. Margins have jumped all the way up from 3.2% to 10.8% itself. We have the express parcel business, which is the mainstay of the company, that has seen some slowdown, but that's in line with the slowdown that we've seen in e-commerce as a channel itself. We've seen growth in quick commerce, but not so much in e-commerce. And total cash balance at close to 5,500 crores makes them a lot more stronger than what they were earlier. And remember, scaling up of their acquisition of Ecom Express will be the next big trigger for delivery. So to that extent, see the stock to be in the green today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's go across to Ria. She's here to tell us about HAL. Ria?
Well, yes, good morning. HAL is expected to be in focus once again today after very strong commentary from the management in their earnings call on Friday. They've said that their order book now stands at rupees 1.89 lakh crores versus just about 94,000 crores that we saw in last year. Order inflows have also been very strong at 1.25 lakh crores, and going forward, they have an order pipeline of 1 lakh crores, which is expected to materialize within the next 1 to 2 years. In terms of the outlook, they've said that the revenue growth is expected to be at 8 to 10% for FY26, but they are going to revisit this guidance after 6 months, and the double-digit revenue growth that they are expecting FY27 onwards may happen in FY26 itself. Margins are expected to be maintained at 31% over the next 3 to 4 years. And another important update on the LCA Mark 1A aircrafts, 12 of these aircrafts out of the total 83 are expected to be delivered in FY26 itself after the engine deliveries from GE have started flowing in. So overall, very strong updates for HAL, and the stock is expected to open in the green today.
Absolutely. It's still defense focus that continues. Ria, thanks very much for that. And some of these stocks are actually holding out fairly positive. Delivery, data patterns, NBCC, these are some of the names. Newsmakers on the upside. Then there's, of course, Zen and the others that are still holding up. But other than that, it's extremely quiet. You can actually argue that this would be a better opening than what the global markets have been indicating, remember? Because US futures are down between 0.5% to 1% because of this Moody's downgrade, general sense of profit taking, a little bit of a pause after the rally. Asian markets have been a little downbeat as well. So compared to all of that, maybe, a flat opening is par for the course. We've also had a good run. Remember, the Nifty is just about 4.5% away from the all-time high. The cap index is about 6.5% away from the all-time high. So it's been a very solid showing. Slow and steady wins the race, as they say at times, right?
Well, that's right. We'll see how a few of these companies go as well. Credit Access Grameen, one of the casualties, I think, this morning, besides Protean e-Govern. Protean e-Govern is down 18-19%, but Credit Access Grameen as well down close to around 5%. But the final 10 seconds, we've got the pre-open rates up for you on the screen. But now, in fact, the markets do open. So let's get straight to the action, Prashant.
Let's do it then. Let's just have the first rates, which will come up on your screens. It's 25,000 on the Nifty. It's Nifty Bank, which is starting at about 55,357. It's absolutely quiet, nothing. The sensex is down about a quarter. The small cap index is up 0.6%. So broader markets, at least at the word go, at least in terms of open, looking a little higher as compared to the large cap indices. A quarter and 0.6 in the mid and small cap indices, respectively, is what you have. What is coming up on the Nifty heat map? So nothing big, I'm assuming. It's mostly evenly split between what is up and what is down. I can already spot the lone defense name on the Nifty stock index, which is at the other one end of the gainer spectrum. It was all defense. I mean, there is only actually, it's of course great news for the sector, but it's also quite telling for the market that actually that was the only sector which really has been standing out actually the last, 5, 6, 7 days now. Infi is at the other end, but I can spot TCS as well, and HCL Tech and Tech Mahindra. So it's a bit of a IT on the other side of the spectrum. So that's the Nifty heat map, which is coming through right now.
It's like one trick pony, as they say, right? And for the market, defense has become that over the last 2-3 sessions. Even this morning, Mazgaon Dock, Cochin Shipyard, Garden Reach Shipbuilders. There's still some, trailing momentum left in these stocks, 4 to 5% higher, 7% for instance in Cochin. But other than that, it's extremely quiet. Let's talk about the Nifty now. IT is down. TCS, Infosys, HCL Tech, all of IT is lower. Tech Mahindra, all of these stocks are lower. So that's one problem. IndusInd Bank is falling more. IndusInd is down about 0.5% right now. By the way, in the last 1 year, IndusInd is down 45%. That's the kind of wealth destruction that has happened over here. So these are some of the weaker spots. The Bank Nifty is very flat at this point in time. If you talk about the majors like HDFC Bank, totally flat, directionless. Ditto for ICICI Bank as well. Let's look at Reliance. Reliance is about 0.5% lower. I'm looking at all the heavyweights right now just to get a sense of direction. Flat to negative, that's what you're getting. L&T down about 0.25% as well. So let's see then what's up. What is, the little bit of green that we have. BEL, JSW Steel. Again, it's more of the material commodity kind of plays. JSW Steel, ONGC, these are some of the stocks on the upside. There's still some buying on auto, by the way. This is what we saw last week as well. So Bajaj Auto, Tata Motors, Eicher Motors, some buying over here. But other than that, it's very, very quiet. Not even 1 point up or down on the Nifty. Nigel.
Well, that's right. From the broader markets, but there are stocks that are moving around here. Banco products, there's one of the big volume movers. You just have to check what is the market cap. But for the time being, that one, in fact, has opened up, gap up. It is up close to around 20%. 7,000 crore market caps are not too small. Those results look pretty good. So that explains why that stock is flying away in today's trading session. A couple of other big movers. Data Patterns is up 6.5%. We'll get the management shortly. Mangalam said delivery delivered this time around after a while. So the stock is up 6.5%. Good move out there. KRBL, we'll try to get the management in, later on in the show, or maybe in the next hour or so. So that one, in fact, is up close to 6.5% post its numbers. Good up move is what we're seeing out there. PNC Infra is well up 5.5%. So smart move on that particular counter as well. So there are a fair bit of winners out there. Zen Tech, I think, should be already mentioned that. That stock, in fact, is moving from strength to strength. So the markets, as we speak, well, the mild dip has got bought into. Stocks are moving to their own tune, it seems. And we made this point last week, right? The Nifty is at around 25,000, but portfolios are not feeling like 25,000. Well, now, in fact, we do see the broader markets in the last few trading sessions have actually been doing an outperformance. A couple of stocks are under pressure. JG Chemicals, stock is down close to around 4% as we speak. In reaction to its numbers, I recall one of those stocks that rallied big time in the last week. It seems the street wanted something more out there. So that's why that stock is seeing some correction.
There's a bit of a PSU play. I just want to mention that over here. Railways and PSUs in general, little bit of gains here and there. So Aircon, RVNL, NBCC announced some orders as well. They've, I think, sold off some apartments in Noida. So that, things like SJVN, NALCO, IRFC. It's a bit of a PSU play. Even the PSU Bank, Central Bank of India, IOB, UCO Bank, all of them seeing a little bit of green.
I think this is the railway stocks actually. When I looked at Friday to Friday towards the end of the week last week, some of these RITES and Aircon, etc., showed up as the big gainers last week as well. So maybe some continuing momentum here. Big volumes, 2 million shares on names like Aircon. But by the way, it is still all defense, I have to say. The top 3 stocks on the volume-led gainers list on the NSE are all, there's Cochin Shipyard, which is up 6%. Number one sort of volume-led gainer right now, 2150. It's gone up like a rocket. 100 rupees again now, 2.6 million shares traded. Data Patterns is up 8.5%, and you'll hear from management shortly. And then there is Paras Defense, which is up 5%, so 1880. So these are the 3 largest volume-led gains coming through. And Premier explosives, 14% on that one. So that is coming up with very large volumes as well. Not Premier Energies, Premier Explosives, that's 562 with very, very sharp gains at this point in time. Astra Microwave is up about 4%. So it is again, I mean, not just in the top three, but outside of that top three, top five list, there's a fair bit of defense smattered around with regards to gains that we have on our hands. Let's actually start with that, right? And let's get somebody on who is really a keen observer of course, businesses, cycles, but also, I mean, doesn't take his eye off valuation. Sanjeev Prasad is our guest on the program, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Good to have you with us here on the program. Thanks for your time. So let's just, if you allow me, defense, Sanjeev. It's a large space now. It's not a small space in terms of market cap, etc. What are your thoughts? What is your view? What's to be expected that after Operation Sindoor, there would be a sharp spotlight on this entire space, indigenization, replenishment, etc. But when you're investing, you've got to have an eye on what you're paying as well in terms of valuations. So that's my question to you, Sanjeev.
See, first of all, this theme is great. Obviously, given whatever is happening in the world, geopolitical uncertainty has clearly increased a lot of risk of more conflicts, etc. Obviously, the government of India also needs to do the necessary and invest more in defense. Having said that, there are three important things to keep in mind. The nature of future warfare is going to be very different from what we have seen in the past. So whether India should be investing in conventional, weapon systems or completely new weapon system, that is up to the government to decide. But one thing is becoming more and more clear, war is going to be very, very different in the future. And as you would have noticed, some of the hardware, which was very, traditional hardware, which was used in, let's say, most of the traditional wars, they have all proven to be rather useless in the new kind of warfare that we are seeing. Biggest example is tanks, as an example. They got badly exposed in the Russia-Ukraine war. One precision missile, even from a shoulder-launched rocket, can take out a tank now, and you're wasting so much money over there. Similarly, if you look at aircrafts, are they really as useful as they used to be in the past, given the fact that you have drones which seem to be a lot more, useful, much more cheaper. Battleships, again, a big question mark. They are very slow-moving, and again, given the nature of warfare, could be badly exposed, against missiles and drones and missiles, So there has to be rethink in the kind of equipment that India needs to have, obviously, and accordingly, investors also need to take a call, whether they should be investing in the traditional hardware type companies or in the newer, companies which have, weapon systems which are more, designed for the modern warfare, which could be very, very different from the conventional war. So that number one.
Yeah, Sanjeev, and by the way, we should have all the defense stocks at the bottom of the screen because, or maybe on the side, if we are already showing it, because that once again is the sector of the day by far. And many new names have now joined the leaderboard here. What should investors do though, Sanjeev? Again, it's come down to what company, what are you paying? So what should investors do, viewers who are watching?
It's a very, very tough call. People are simply buying into narratives. See, first of all, what will the government, who will the government give orders to? How do you know, first of all? People are just buying anything and everything without looking at, whether the nature of warfare is going to be the same as in the past as explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make really, very little sense to me, at least. If I look at, let's say, something like a potential PR, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores. One second, and the profit which it had done, not much this year, So that's the whole struggle for me, when I look at many of these companies, that kind of valuation these companies are starting to get now doesn't make really much of a sense, to be honest with you. Sorry, Kochi Shipyard.
800 crores. Sanjeev, 800 crores in profits.
800 crores profit, 55,000, so that's 70 times, right? Net worth is about 50 billion, so 5,000 crores, 55,000 crores market cap, so that 11 times, net worth. Is that really such a valuable company? I don't know. Maybe in the future we need a lot more orders, and it needs a lot of orders to justify the kind of market cap the company is trading at in the context of the net worth or the PAT, whichever way you want to look at it. There are many such examples, Mazgaon Dock, 1,40,000 crores market cap, 5,600 crores net worth, that's it. I don't know, I only have the 9-month numbers. PBT was about 2,700 crores. Investors can take the call on valuations, and decide whether it makes sense or not.
So what is a reasonable valuation to pay in that sense, Sanjeev? Or is there one? Or how do you assess?
It depends on the type of company, and I can't make a generic,
No, you have coverage on anything, Sanjeev, here? I think BEL, etc. you would.
BEL and Cochin Shipyard.
No, if I could just, ask a final question on this and then we'll move on, Sanjeev. Again, one of the narratives or one of the talking points that I heard in the last couple of weeks was that you need to go beyond just looking at P&L and traditional price to earnings while looking at the defense opportunity. These are very large order books and the money will come, but it'll take time for the order books to translate into P&L. So this gentleman was talking about not ignoring the large order book while deciding on whether the stock is overvalued or not. Your thoughts?
Sure, you can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Cochin Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores. Yeah, to take 10% PAT margin. Yeah, you will make about 5,000, 6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier. And that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PV of the 5,000 crores of that opportunity which Cochin Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there is no way you can justify this kind of valuation.
That's a strong argument and absolutely one that we've taken on board. And I think investors need to hear all sides before they decide what they want to do, because the stocks have indeed run up big time. Okay, that's a lot of defense, Sanjeev. Now let me broaden this out. Let me ask you about the market as a whole. The thing is that I think in an environment where not too many sectors are giving you growth, maybe that's why people are latching on to wherever they see opportunity. Overall, how do you rank the earnings season and what lies ahead? Do you see at least 12% earnings in FY26 and then tie that with the market valuation?
12% looks too optimistic, I would say. We have only 10% now for FY2026. That's for the Nifty 50 index. And that is also at some risk because we don't know what happens to many of the global sectors eventually, in terms of growth, given the challenges which many of the countries are facing. You have a lot of uncertainty on the trade tariff issue, which I will talk about later on. So in that context, 22 PE for the market on March 26 looks on the higher side. The more important thing is not to look at the index as a whole, because anyway, you're not going to buy the Nifty. You're not going to buy the stock. The bigger problem still remains, I made this argument several times, and in most cases, multiples are significantly higher than historical levels, or far lower growth and a lot more uncertainty, far higher global interest rates. So in that context, many of these stocks don't really make any sense. I mean, look at India Consumer Staple Company. Most of us are trading between 40 to 60 P. The kind of volume growth this company reporting is, lever is down to 2% now. Nestle had hardly any growth last year. I mean, hopefully things will recover. But even if they go to, 4-5% volume growth, some inflation, some premiumization, it is very tough to justify 50 PE multiple now. If you look at when they were trading at 50 PE multiples, they were going much, much faster. So that is the whole challenge, and this is true pretty much across the board. Every sector, you're seeing the same problem of very, very high valuation.
Yeah.
I mean, market, obviously sentiments have changed very dramatically. In the last 1 month or so, we have gone from absolute despair around when the reciprocal tariffs were announced to some amount of relief when the reciprocal tariffs were suspended to complete euphoria now. Now, if you look at the reality, what has changed? All we know is that the reciprocal tariffs have been postponed. They have not been removed. And I think investors need to really appreciate this basic point that we are on hold for 90 days. 40 days already over. We need to see, where tariffs settle finally, all sudden tariffs will be higher than wherever they were before this whole saga started. Yeah. So that is not good for growth, that is not good for inflation, that's for sure.
At the beginning of this year, and this is the point we put out in the morning, the beginning of the year, US effective tariffs on China were 11%. They are 39% now, after the deal, which happened last weekend.
And this is a lot, by the way. Right? The prices will go up a lot in the US, so inflation will be there. Some investors simply not bothered about any of these facts. People assume that, all the problems are solved, which is what worries me a little bit over here, that, incremental news has been positive. If I take it from April 8th, let's say, which was, just before the tariffs were suspended. But incremental news, if I compare with the beginning of the year, is very negative. So
sure.
The two things, right?
Sure. Sanjeev, very quick two-part question. First part is, so you're saying 10% earnings growth this year. Nifty is already at 25,000. So flat for the rest of the year? I mean, just in terms of a market move?
Earnings will be, I'm not somebody who forecasts prices. All I know is that, valuations are expensive. Fair value of most of the large cap names are near, current prices or, the current prices are well above fair value in many cases. That's a struggle as of now. On any bottom-up first principle basis, it's tough to justify the current market caps of pretty much, I would say, 90-95% of the market.
Wow, tough to justify the market cap of 95% of the market. That's saying something. So that my second part of the question now.
I can have any debate with anybody on this point. So
I would love to have that. I think we'll do that in one of these days. But the second part of my question is that are foreign flows the only risk to the narrative, to the whole very strong and very logical argument you've made? Because those dollars have started coming in for other reasons, because of growth concerns in the US, tariffs in the US. Could that be an upside risk, maybe a pleasant upside risk from the investor's perspective?
Everybody is taking the call that US will not do well. US is up significantly, by the way.
That's
US
true.
Index, S&P index is up 19% from April 8, by the way. India is up only, I think, 11 or 12%, something like that. Yeah? So this whole belief that somehow US will not do well and India will do well, I don't know where that feeling is coming from, right? Actually, the S&P is far higher. It's almost close to its peak. So is the Indian market. So what has changed? Nothing has really changed, So there's an assumption that India will get a lot of money. I don't know where it is coming from. And ultimately, foreign investors do look at valuations, right?
Yeah.
Valuations are high. I think there is no debate in this. Second view about that. Anybody saying that valuations are cheap needs to get his or her head examined, in my view.
Point taken, Sanjeev.
To be honest with you now, yeah.
Yeah, just very, very briefly, Sanjeev, you put out a note essentially looking at the retail investors and what they are doing, right? You said that they've increased redemption in mutual funds, they've increased selling in direct equities, increased SIP contributions, but they stay invested in narrative stocks, which makes for a heady, for an interesting cocktail and possibly a hangover. So, which is the weak link in these four things? The last one?
Retail investors' flows, not that I'm a great believer in flow, that's a driver of market, ultimately changing expectation matter a lot more. For whatever it is worth, anybody who believes that retail has been the driving force of this market, which it has been some extent, at least until recently, they were price agnostic buyers. Their sentiment has started to weaken for sure. If I look at the data of direct, that is activity of retail investors in the market, that number has been negative for the last 3 months now. That is, they've been selling and FPIs and DIs and others have been buying. Yeah. Second thing, look at mutual fund flows. They have started to slow down compared to, let's say, the 6-month average of October 24 to March 25. The April number was about 1/3 lower. Main numbers from whatever we can track seem to be not looking very good, and that's input we're getting from other some of the mutual funds also. So the whole point is, is a section of retail investor community getting a bit concerned about the market for whatever reason? Market has gone up sharply. Maybe some of them are using that to exit, etc., etc. At the same time, we are seeing a lot of action once again in what I call the narrative stocks. Some of the names which you talked about. So I don't know. On the one side, a section of retail investors seem to be getting cautious, looking at the flow data. Other side, if I look at the activity in some of the narrative stocks, which honestly have struggled to justify valuations of, one set of investors seems to be pretty bullish or very bold, in fact. So I don't know how to reconcile the two things. Obviously, retail investor is not one uniform mass. We have different types of people, different risk-taking abilities, and so on and so forth. One side seems to be getting more cautious. Another side seems to be getting a lot more bullish. Let's see.
All right, Sanjeev, appreciate you joining in. Thanks a lot for giving us that commentary. We look forward to having a chat with you as the year progresses. Well, keep an eye on a couple of stocks. Actually, the graphite electrode companies, that's both HEG and Graphite India, both of them are bursting higher in trade. We have Resonec Japan, which was the erstwhile Showa Denko. They have halted graphite electrode production in China as well as in Malaysia. The reason that they're citing out there is margin pressure. Keep in mind, Resonec, well, they have a rough capacity, as per their website, of around 210,000 capacity. That's approximately 30% of the global market share. So that's the reason, in fact, we're seeing these stocks spurt up, because there could be some kind of a shortage in the global graphite electrode market, which explains why, these stocks, in fact, they are currently moved to the high point of the day. We'll have to see how things pan out. But remember, the margins had come down. If there is a shutdown globally for the large player, which has 30% of the market share, that could mean that, in fact, pricing at least gets a bit of a fillip. We'll have to check out to see how exactly the needle coke availability as well moves up. But that's clearly playing on it. Back of an envelope calculation suggests that the total global market share, ex of China, is around 30%. So around 30% of their production, which equates to around 8 to 9% of the global capacity, ex of China. So let's see how that goes. For the time being, both these two stocks are moving up, because over the weekend, this news flow did come about with regard to Showa Denko, or Resonec, so to call it so. We know these stocks, the way they move, just highlighting it for our viewers.
Obviously, yeah, that's a great one to pick that up, and it explains that in an otherwise lackluster sort of a market.
We'll have the management of HEG actually in the next couple of days when they come out with their numbers. So we'll understand exactly what kind of a shortage it can create globally. But we know these stocks, they react to this news flow very, very violently. So we'll have to look through the fine print. But some kind of shortage globally will definitely support pricing.
Absolutely. All right. So we'll keep an eye out on these stocks. For the time being, back to some earnings and back to some defense plays as well. Data Patterns is the next company on our radar. And we have Mr. Srinivas Gopalan Rangarajan with us now. Thank you very much, sir, for joining in. And it's been a very good quarter as we get this conversation started. I'm just pulling up the numbers as well. For the fourth quarter, your revenue is up 117%. Your margin is at 38% versus 51% year on year. But the profit has grown very smartly, about 61% as well. Can we start by talking about the order book? The order book declined quite a bit, 33%. I mean, clearly you're executing. But what's the visibility, sir? This year, FY26, what is the visibility on the order book growth? And then we'll talk about revenue as well, the revenue growth that you are looking out for. Please.
Yeah, thank you. Our last year order intake has been quite lower than expected. It's got postponed, but they are intact. So we expect the contracts to happen this year. We expect more than about 1,500 crores contracts to happen this year in terms of new orders. So our revenue guidance remains 20-25% on top and bottom line growth.
Okay. Revenue guidance for FY26, 20 to 25%, both on top and bottom line. But order inflow, your guidance in FY26 was about 700 to 800 crores. Now, wherever you fell short, what is the timeline? When do you expect the orders to finally flow through? And for this year, what is your, your expectation? Say by first half, where will the order book be? And by the end of the year, if you could give us some idea.
Yeah, we expect in the first half, we should get probably 600 to 800 crores of contracts. And the rest, about 1,000 crores orders we expect during the course of this year. So the contracts have got delayed, but this is likely to happen in the next 5-6 months' time.
So if you could just give us a number, the order book as of 31st March FY25 versus where do you see it by the end of FY26?
We expect about 1,200 crores FY26, end of FY26 is what we're expecting after executing contracts during the course of this year. There are a number of products which have started development ahead of time, and these are coming to some level of completion. And if these contracts also happen, that will be a big boost to our order book.
Okay. What about margins, sir? Again, I'm talking full year margins. In FY24, you were at 43%. That number came down to 39% in FY25. Obviously, it will depend on the kind of projects you're executing, the product mix as well. So just tell us what happened here. And as you talk about building up the order book again, what will be the margin profile for these new orders that you're awaiting?
Last year, or the year before last, we took some strategic contracts, very large contracts, which involved just not the electronics, but the first full system. We took this as an important step towards moving from only electronic systems to complete equipment. And that was very important to us from a data patterns capability upgrade point of view. So we've done that, and that has given us a lot more competency in addressing big markets and big contracts going ahead. So we took the strategic decision, and those contracts were of lower margin. However, we were able to compensate that with other contracts with normal margin. That is why you see a dip in overall margin. At the same time, the bottom line business has gone up, maintained the 20% growth, which we committed to the market last year. Going ahead, I think we continue to keep it's a bottom line business. We are IP-driven business. So we will retain our bottom line as we go ahead. We may take some 1 or 2 strategic contracts with lower margins, but that is to build the competency in the company and large markets going ahead.
It's interesting that these strategic contracts are actually coming at lower margin versus the specific product contracts, is it?
Yeah. See, what I mean by strategic is that we've never done complete systems like building, construction, all of them, which goes into the complete radar.
Okay.
We've taken up these things because when you look at opportunities, they're coming not just for electronic parts and subsystems and radars, but all the conglomerate systems which go along with that.
End to end.
End to end.
End to end. But end to end is slightly lower margin. Got that. Versus just the radar or just the equipment that you would be supplying. Understood that. Thank you.
All right, sir. Let's focus a little bit on the international opportunity then. The international order book, I think, is currently mid-teens of your total order book. How much is expected to increase, say, in FY26, international business as a percentage of your mix? And what are the markets you're targeting? Europe, East Asia, if you could name a few. And also clarify on margins of export business in comparison to domestic business. Is it better? How much better?
Last year, we did very good export business. We did about 15% of overall revenue was in export. This is mainly to Europe, East Asia, as well as UK. We continue to have order of about 100 crores from UK. So the order is there, and we're also getting more orders from there. So we delivered a system called transportable radars, transportable precision approach radars for flight guidance and for aircrafts. Now that we've sold the first systems to NATO country, we've got other inquiries coming from the rest of the world. Maybe this will also pick up as we go along in the course of the year. The focus, but however, has to be in India. There are a lot of large opportunities in India. I think we need to address those opportunities. And parallelly, we should start looking at export business. What we do development here can also be exported because what we're designing is our world-class systems.
Okay, and margins of exports, I missed that point. Is it better than India?
No, it'll be around similar range. Some systems where we separate OEMs will be lower, but still reasonable margins. And going as a complete system, if we sell it, then the margins will be similar to what we do in India.
Okay, got it. What about your capex plans, sir? Since you're indicating that there's a big potential out there for your company as well as for the industry, what kind of a capex plan do you have? What is the turnover that you're looking at, asset turn out there? And by when do we see this?
See, capex is going to be in 2 parts. We raised about 500 crores 1.5 years back. This is essentially to do product development and build capex. We spent more than 150 crores on product development in the last 1.5 years. Those products are at a very near stage of completion and going into trials. This is to really enhance our TAM going ahead because we need to be a 5-10,000 crore company. We need to have at least a TAM of 30,000 crores. These products will address a very large market. That is that some world-class equipment we designed with in-house IP. So that is coming up. Second, we're also going to spend about the next 1.5-2 years, about another 150 crores, which will be spent on building an infrastructure and test equipment. This is to address the large opportunities. If we get the contract, we should be in a position to address and deliver on those opportunities. So we're moving ahead, seeing that everything is, the foundation is maintained and kept. We're also recruiting more. We are now really about 1,100 engineers working with us. So all around, we are building competencies and capability to address the larger opportunities we expected to happen in the coming years.
Okay, all right. Thanks a lot, sir, for joining in. We look forward to chatting up with you as the year progresses. For the time being, you're sounding quite optimistic on prospects. But let's focus on another company, Kaynes Technology. They actually reported a good quarterly performance, healthy margin expansion as well, and strong order book. They've also completed an acquisition to expand in North America. To discuss this and more, we have Mr. Jairam Sampath, the whole-time director, as well as the chief financial officer at Kaynes Technology. Hi, sir. Morning, and good to see you in as always. Well, the numbers look good, order book is good, but it seems valuations have got a little bit stretched after the 30% run we have seen in the last few months itself. And that's why I'm reading a few notes today. There are a couple of downgrades on the stock. That's from the market perspective. But let's get a couple of numbers out of the way. On this sort of a base that you've delivered for the past year, what kind of a revenue growth you're looking at, what kind of margin expansion, and also export contribution, you're expecting it to go up, I think, from high single digit to mid-teens. Tell us more.
Sure. So as far as the guidance for this year is concerned, FY26, the existing business, which is excluding some of the acquisitions, will grow at about 60%. So we get about 4,350 crores of business we estimate for this year. And on top of it, we have acquired a company called August Electronics, and shortly we'll be consolidating that company's results into us. So we expect about 6 months worth of consolidation. So that would add about another 175 crores. So roughly, total what we are looking at is about 4,525 kind of number. Based on our order book and kind of businesses that we plan to execute, there will be an expansion in margin by about 50 basis points. So maybe we get to about 15.6% kind of an EBITDA number for FY26. As far as exports is concerned, FY26, you can see when we say exports, we're talking about exports out of Indian facilities. So it will go a tad increased because we will have some US major company orders getting executed. We've got a significant amount of business that has come in. So we will start doing additionally about 200, 300 crores of exports. So this is US-based as well as Europe-based companies that are in both aerospace and in automotive area. So you can see an uptick on the percentage of exports too by 26. And of course, at the end of the year, I think our businesses in OSAT and PCB is also going to fire up. And so they're also export-oriented businesses mostly.
Okay, all right. So from OSAT as well as PCB project, what kind of revenue contribution will we see in FY26? I think it comes towards the later part of it. And I think majority of it will come in FY27. So for both these two businesses, what kind of revenue contribution we'll see in 26 and 27? And also your capex plan is 1,000 crores, right? Break it up for us. EMS, OSAT as well as PCB.
Sure. So I'll answer the second question. Firstly, whatever money we raised during last QIP would suffice for managing the capex spend for both OSAT as well as PCB. As far as the EMS business is concerned, about 200 to 300 crores of capex will be required every year to cater to the growth, which we expect it to be excess of 50%. And that would entail some kind of investments in the factory infrastructure and all that. Now, as far as the OSAT and PC board businesses are concerned, being fourth quarter, right now the factories are under, let's say, construction. And while we have LOIs from customers and so on, and a lot of strong customer pull available right now. So once the factory is ready, then there is a process of approvals. So in the fourth quarter, we don't expect huge amount of revenues, maybe 50 to 100 crores kind of revenue you can expect from each of these businesses at the end of the year. But we would maintain our guidance based on whatever existing businesses that we already have. That's EMS and one more acquisition that we have done in North America so far. So you can see a full-fledged year for these two businesses in FY27. Because by September, probably the factories will be ready. Then there is a customer approval process, which probably will happen by December. So January, February, March is the time frame when we will do some little business in these areas. So it's too early to say exactly how much, but yeah, it won't be a very huge number, but at least it will cover all the major customers, like a couple of customers in OSAT, and then in PC board there are.
Jairam, if I can come in, morning, Prashant here. So for FY27, could you give us a sense of what could revenues be from these two businesses, OSAT and PCB?
Yeah, OSAT and PCB, probably both of them put together will be 1,000 crores plus kind of business. Maybe earlier we were thinking that FY28 we would get about 1,500 crores from these businesses. Maybe we'll do that in FY27 itself.
Okay, that's FY27,
Yeah.
which is between 1,000 and 1,500 crores. And what margins here?
Okay, so right now all drawing board margins right now, because we have to yet establish costs and all that. But they'll be more than our current consolidated margin. They'll be in 20s. EBITDA margins will be in 20s. Yeah.
And there are no changes per se, Jairam, because of all the there is so much movement happening, right? With regards to news flow, make here, make there, don't make here. I'm talking about what the news flow with the US, and these are all considered. I mean, of course, we are talking about packaging, etc. for now, but also building the ecosystem as the first step. There's no. Are there anything you're hearing from clients in that sense, or is it a fluid situation?
No, this is something that we had anticipated. That's how we acquired this Canadian business of August Electronics. I think going forward, you will have more and more of what I call the insularity in manufacturing. Whatever best they can do within their country, they would, again, I think, rededicate themselves toward developing a manufacturing base so that no country has strategic importance in terms of their entire economic value chain. So we've been talking about our geographic footprint increasing to North America, Europe, and of course, at some point in time in future into South Asia too. So this has not come as a surprise to us. We also know that the business's growth vectors cannot be based on protection by the government. Of course, we do use all the different types of benefits that government gives us in terms of capital subsidy, MPLI, etc. But at some point in time, that will be available to most companies in the world, right? So we do understand that, and so we are taking steps to make sure that we give technology as the key differentiator. Since we are investing now, so we can always choose to invest the high-tech infrastructure. And also we look at more value-adding propositions like ODM and all this, our own design and so on.
Mr. Sampath, just very quickly, so you gave us a sense of FY27. That's where PCB and OSAT kick in, and you get in about 1,500 crores of revenue from those businesses.
Yes.
Now, specifically for FY26, the current year that we're in, you're guiding for a 60% growth on the top line and an improvement, about a 50 basis points improvement in margin.
Correct.
I just want to understand how that will come about and what's happening with the base business, with the EMS business itself. Your order book is at about 6,600 crores as of the end of the year that just closed. Just give us a sense on the base business and the projections that you've put out.
So the 6,600 crores of order book represents orders for 5 years time frame from today, right? There are orders in our books beyond 5 years too, which we don't consider for projections of these order books. Having said that, typically the next 12 months would represent about 60 to 70% of this order book. And so that means that for the coming year also, some orders will come in because many customers do not give you orders beyond 12 months. So they would give it as and when. So 6 months to 10 years is the time frame in which different customers give us orders. So from the order book perspective, we can always compute what is the kind of EBITDA that we can make, assuming other things are being equal. So that's what tells us that this year, because of course, we can't tell you sector-wise, but broadly the uptick is in industrial and in aerospace and in railways and in IT, etc. So these sectors are typically pushing this entire margin profile up a little bit. And also, I think this year some more operating leverage will kick in. Last year, we kind of deleveraged because we are spending more money than we ought to. And this year, we will probably utilize those, and even asset utilizations will improve. So we are expecting at least 50 basis point expansion in our margins at EBITDA level.
Okay. All right, Mr. Sampath, thank you very much. Lots of details there. Good luck with your plans.
Thank you.
We look forward to the next call soon. We'll take a break on that note, come back on the other side, and we'll be in conversation with the management of Vinati Organics to talk about their fourth quarter performance.
Welcome back. Well, Vinati Organics, that's the next company on our radar. The performance was largely in line, but what's the way ahead? That's what the street would like to know. Well, we're joined by Vinati Saraf Mudreja, the Managing Director at Vinati Organics. Hi, Vinati. Good morning, and thanks a lot for joining in. Well, let's focus on the largest part of your business, the ATBS segment. What kind of volume and revenue growth are you working with for this year? And you had an expansion that was due, right, at the first half of the year itself. I think in the first quarter, it was expected to go live. Could you tell us if that is on target, and how do you see capacity moving up as well from here on?
Yeah, absolutely. So this year, a large chunk of our growth did come from ATBS. Last year, there was a bit of tightness in demand for ATBS, which we saw improvement in FY25, and about 25 to 30% volume growth is what we observed in ATBS. Going forward, I'm expecting a similar growth. As of now, we are running at full capacity. And just to address that issue, we are adding 2 new lines of ATBS, in fact. The first line is expected to commission in Q1, like you rightly pointed out, and we should have some added capacity to fulfill the backlog in demands starting from July this year onwards. Post both the lines in completion, our total capacity of ATBS would have expanded by 50%.
Okay, would have expanded by 60%. Vinati, hi, good morning. Prashant here. Could you talk to us a little bit about the core demand and how that is shaping up? Give us a breakdown in terms of volume and pricing both.
So, well, demand largely for all products has been good in our case. Mostly, again, ATBS, a large chunk of the application that is growing is coming from the oil recovery segment. ATBS, as you know, is used in oil field and oil recovery polymers. We also see a strong demand coming from water treatment and mining industry. My other products, such as the antioxidants, which has grown by more than 50% this year, which goes in the polymer industry. We've seen a very strong demand in India as the polypropylene and polyethylene capacities have increased over the last 3 years. Again, butyl phenols being a feedstock, even that plant, we are running at close to 90 to 100% capacity. We are increasing our isobutylene capacity, which is used in agrochemicals as such in cypermethrin. So demand remains positive and strong, and a lot of it is coming from the domestic sector.
Okay.
You know, you mentioned that you're working on 3 to 4 new products, which will drive the next leg of capex, and these are all based on adjacencies. I mean, with your existing products, could you talk to us a little bit about this? How large are these product segments?
Yeah, so a lot of the new products we are adding in the subsidiary, HAL Organics Private Limited. We are adding a polymer inhibitor. We're adding a product that's used in the pharmaceutical industry. We are adding isoamylene-based derivatives, which go into agrochemicals as well as plastic industry. PTAP is specifically the product. Now, as such, each individual product has a revenue potential of about 100 crores, but total, the basket of 5 products, the total revenue potential becomes 500 crores at full capacity utilization.
Okay, all right. Vinati, give us a few more details. You know, the antioxidants as well as the butyl phenol. If I got it correct, I think it's around 20-25% of your mix. You could correct me on that number. But for this year, I believe, you're guiding for bigger numbers. So between the two, what kind of revenue number could we see between these segments?
Well, you're right. This year we did about, combining the two, we did about 550 crores in revenue. Next year, this number should cross 700 crores, but that will still remain about 25% of our total revenue, as the growth will also come from ATBS and the new products that I talked about previously.
All right. So for the company on a consolidated basis, what kind of a revenue growth should we look at? In the last quarter, what was positive was your margin surprise. What is the steady state margin range we should work with?
Yeah, so, on a long-term basis, I think over the next 3 years, 15 to 20% annual revenue growth is a fairly acceptable, achievable number. Margins, again, I would expect EBITDA margins to remain about 26 to 27% on average. This quarter, you might have seen slightly expanded margins. That depends on in the quarter where we get more of the custom synthesis products. So those are campaign-based products, and they don't happen every quarter. So it's just a timing issue in that regard.
Okay, all right, Vinati. Appreciate you joining in. Thanks a lot for giving us color on the way the last quarter panned out and the way ahead as well. Well, for the markets, though, well, we're holding with a mild negative bias on the Nifty, but stocks are moving around from the broader markets, and they're moving big time, actually, because the breadth of the market is still in favor of a number of stocks that are advancing. A few stocks to highlight. Banco Products, we mentioned this, that's up close to around 20%. The biggest volume buzzer is HEG and Graphite India. We know that these stocks, any kind of supply constraint in the global markets, well, in fact, you see both these stocks take off. And that's precisely what's happened, because there could be some kind of near-term supply downtick. That's why both these two are moving up. But we'll have to hear in from the management. Remember, these are companies that at one point of time delivered margins of 65% that have come down to mid-teens as well. So just keep that in mind. But supply shortage normally holds well.
The Arya power stocks. I think you used that word violent. Yeah. That is absolutely the correct way to describe, because the moves are not small. They're never small. Either they go big or go home. And today, these stocks are moving in a big way. I just want to highlight one name. Cochin Shipyard has lost $200 from the day's high. And it's still the number one volume-led gain. Actually, it's now it's a loser, but it's got humongous volumes. And look at what has happened. Maybe the market paying heed to that conversation with Sanjeev Prasad. I think Sanjeev did use Cochin as an example. I mean, he was, of course, not talking about Cochin and what you should do with Cochin, but just was basically saying that many of these names, purely based on valuations, it'd be hard pressed to justify. And actually, it's similar.
Even Mazgaon,
same was the case with Data Patterns. Data Patterns, Surabhi, the high was 3,141. It's again dropped about 150 rupees from the day's high. Look at this. This is all almost similar kind of price pattern. Look at Paras Defense. High was about 1945. Stocks at about 1850. So again, about 100 rupee drop coming through from the day's highest point. The one name which is still holding on with decent gains is Premier Explosives. But again, here the high was 580 and it's dropped about $30 from the day's highest point. Actually, there is one more. Look at Astra Micro. High was about 1120 and stock is about 60 rupees off the day's high to about 1,070 rupees or so. So just, I mean, that defense space, very much the focus of conversation here, even on Bazaar for the last 2 hours or so. Lots of views. You heard from Sanjeev, you heard from Deepan, etc. Coming off the day's highest point. Sudeep Shah is with us with some technical views, SPS Security. Sudeep, good to have you with us here. Good morning. What would you recommend? Nifty and then stocks?
Morning, Prashant. Prashant, see what's happening with Nifty is now post that move in the last week, that big 500-point move on Thursday, Friday, as well as today, we are seeing some kind of consolidation happening, and that is quite acceptable given the fact that the moves were very strong in the previous week. Now, from here, we feel that 24,850, 24,900 would act as a key support until this zone holds. The upside up to 25,300, 25,550 looks quite visible. For the bank Nifty, what is important is the 54,900, 54,800 zone will act as a strong support till this zone holds. We feel that the Bank Nifty has been, if you see Bank Nifty, that has been consolidating in this 1,000-1,200 points since last 10 to 13 sessions now. So a breakout here is quite likely in the next couple of days. And that is the reason we feel that on the lower side, 54,800, 54,900 should act as a strong support. Till this holds, we feel that with the breakout, the index can scale up to 56,300, 56,600 levels in the coming few sessions.
Okay. All right. Got that, Sudeep. What about individual stocks? Any advice? And maybe throw in a word on some of these defense names as well. All of them, including the bigger names like HAL, Mazgaon, all of those stocks are finally cooling off.
Yeah. What is defense names last 6-7 days, right from the day Operation Sindoor has concluded temporarily. What we have seen that all these names have just spiked up, giving the if you see the technicals here, they have all gone into an overbought zone and have sustained there for the last 4 or 5 days, and finally they are cooling off. So while the uptrend, a medium to long-term uptrend looks still strong. We feel that in the extreme short term, these stocks can cool off, and dips should be used to accumulate these stocks and not chase the stocks at the current prices and the current valuations. So we feel that one should just step aside from the defense names for at least next 4 or 5 days, let them consolidate, let them cool off, and then take a call on these stocks post the consolidation.
Okay. All right, Sudeep, thank you very much for joining in. Appreciate your call. We need to take a very quick break. Come back on the other side. We'll focus on some individual stocks as well as on commodities. Welcome back. So day of consolidation, at least a morning of consolidation for the market in the equity sphere. Let's find out what's the latest in commodities. We have Manisha with us now in the studios. Manisha, so what's the Monday headline?
Well, you know, everything seems to be buzzing, and on the higher side, we've seen buying return for many of these commodities. But I want to talk about copper because we have very contradicting fundamentals coming in for this one, and there is a lot of disruption in the global markets as well. Having said that, we've started on a positive note for this one at this point. Most of the metals are holding well post the short-term truce between China and US there. And when you look at that report card, as you can see, the best of the gains in this year till time have been in case of copper. At one point in time, we were up by nearly 27% as well. But clearly, copper has come off that. But after that, also, we are holding those gains. Aluminum, zinc down between 3 to 10% on your screens. Iron ore is down 3.5% as well. Steel prices, while are at double digit on the positive, but that also is because China has been saying that they will cut production going forward in 2025. That perhaps seems to be supporting steel. But in the non-ferrous space, copper clearly is the king there. If you look at the US markets, and this is what the street continues to talk about, that US and China, the two major producers and consumers. So when it comes to US, well, 40% of the refined copper demand comes in via imports. And that is the case with aluminum and steel as well, where we already have seen tariffs come in from US. 70% of primary aluminum that US uses or consumes is imported. 20 to 25% of steel that US consumes is imported. So it's going to be quite an interesting to watch on how tariffs and how much and how long do we see here and the impact of that on those metals as well. Come to China then, and Chinese numbers have been quite on the stronger side, even as there has been tariff concerns and we've seen slowdown concerns. When you look at copper movement within China, that has been quite on the positive. Refined copper production is near record levels. China imports for the month of April were quite on the higher side at a record 3 million tons yet again. And then the Chinese smelters are paying to process now. If you look at the treatment charges, they are negative of $57. So that tells you that the Chinese demand has been very strong when it comes to copper. Take a look at the global inventories now, and there's not so much change as compared to last year. We stand at 500,000 tons. But interesting to see is that much of this copper clearly has moved to US ahead of those expected tariffs. So US is looking at an 8-year highs in sense of copper inventories, 81% up in this year. In contrast to that, LME inventories have declined by 40%. They're trading at a 1-year low. And the lowest of the inventories are in China, where you are looking at strong demand. So the Shanghai inventories stand at just about 89,000 tons there. Also, you have the International Copper Study Group telling you that you're looking at a surplus of copper this year and the next as well. So those numbers look on the stronger side as it is. The uncertain only is on whether or not the US will put 25% tariff on copper like it has done for aluminum and steel. And the last plate tells you on the expectations on where the copper prices can be for the rest of this year now. Well, the most bearish of views comes in from Citi. They expect the copper prices to decline to $8,800 a ton in the second half, but it is between $9,200 to $9,500 that you have JP Morgan, Citi and Bank of America talking about copper. Currently, copper is trading at around $9,800.
All right. Manisha, thank you very much for that. So that's commodities in focus there. Well, let's move on. Stocks on the move. Protein e-govern is locked in lower circuit. Vinny's here with the story and, of course, the news flow driving it. Vinny, over to you.
Hi, morning. So yes, Protein Eager was under pressure today. Why? Because now the company has not been shortlisted for PAN 2.0 by the Income Tax Department. This was going to happen in somewhere in August. They had gotten some requests for proposals. Now they have not been selected for this. Now what does this mean? PAN services account to around 50% of their revenues. So this is an important one in terms of going forward, the growth story that comes in for the company, right? If PAN services doesn't come in for them, then the growth in FY26 or FY27, we could see a muted growth coming in on that front. Now, government had plans overall to spend almost around 1,440 crore budget for this PAN 2.0. So that is something they may be missing out on. Equirus has highlighted that this is negative because obviously, like I mentioned, 50% revenue comes in from this segment, has historically been generating a lot of free cash flows, which had helped fund their new initiatives. So now that may take a bit of a back seat as well if there's not enough free cash flow. They've downgraded the stock to a sell from a previous ad, cut the target price to 900 rupees from 1,730 rupees. Also, Anand Rathi is also highlighting that in the near term, this could be a challenge for the company, but they expect limited impact overall, given that core business for PAN comes in from offline. But nonetheless, today we're seeing pressure coming in. PAN services is the major segment for the company, and that is why locked in lower circuit.
Okay, all right, got that. Big hit on the stock this morning. Thanks for that, Vinny. We'll take a break on that note. On the other side, it's our special segment, It's the Economy. Today, Lata speaks with Rajiv Radhakrishnan of SBI Mutual Fund and Madan Sabnavis of Bank of Baroda to discuss how big will be the RBI's dividend and what could be its impact.